Hello and welcome to Fireside with the VC. With the VC, my name is Andrew Romans, and today we've got Jonathan Fish from QSBS Expert talking to us about QSBS. So if you don't know what QSBS is, you should know. If you invest in startups or you invest in VC funds or both. So QSBS is Qualified Small Business Stock. And it's a pretty crazy exemption, which is at some risk of disappearing in certain states or from the country altogether. So we're going to find everything you need to know about QSBS today. So Jonathan, thank you so much for coming on the podcast.
Thank you for having me on, Andrew.
So we're going to talk about your business, QSBS Expert. But first, for those that don't know, what is it? What does it mean?
Yeah, it's the $10 million question, I guess. What is QSBS? So it's a tax incentive to incentivize investment in early stage companies, and the government has various similar programs, some to invest in regions of the country, like covered by opportunity zones, or to invest in certain populations. And with QSBS, it's focused on investing in small businesses and driving investments into those businesses.
Right. So the key moving parts, what characteristics does a company need to have to qualify for QSBS tax treatment to start with?
Yeah. So there are 5 basic criteria. So number 1, you have to be a C Corp. A lot of companies convert, say, from an LLC to a C Corp. So that's okay, but the QSBS stock can't start counting until the company is a C Corp. So you have to be a C Corp. There's certain there's a qualified trade or business criteria. So basically they define this in the negative in the tax law, where there are certain types of businesses that are excluded, and those would be businesses like where the way I think of it is where an individual is the business, or so a CPA working as an accountant as a CPA, or a doctor servicing patients as a doctor. Those wouldn't be the types of businesses that could qualify. Then there are certain industries that are not allowed. So like brokerage or health. And this gets tricky because, what if you're a fintech company that provides some brokerage related services,
Right.
So that starts to get a little tricky to navigate. So C Corp, qualified trader business, the size criteria is really determined by gross assets. So not the valuation of the business, but the actual assets on the balance sheet.
Right.
And the IRS defines a small business for this purpose as less than $50 million in gross assets when the stock is issued.
So before we go further, just to cut to the punchline, if our venture capital fund or if my brother invests into a QSBS qualified stock business, and we normally, if you hold it for a year or more, you're paying capital gains tax on that. If you hold it for 5 years and a day, how much tax do you pay?
Right now, 0.
So you pay 0 on the gain. So you invest $1 million, you make $11 million back. So you have a gain of $10 million, and you pay 0 ordinary income tax, capital gains tax, set down to 0 on this investment because you paid attention and you know what QSBS is.
Yeah, exactly. And you brought up an interesting figure because there is a cap. The cap is $10 million. So, or 10 times your basis. So whichever is greater. And so, there are tax planning strategies that could be employed to optimize for the tax savings, but exactly what you were saying. So now there are 2 other key criteria, because like the question always comes back to, well, is the company a qualified small business to begin with. And this is what a lot of folks struggle with is, okay, I had this gain. Now, I'd like to take the QSBS exemption. I think it's qualified, but how do I prove that? And so there are two other elements, and these are probably the trickiest elements to prove. One is we discussed the less than $50 million in gross assets, but then there's what they call an active business requirement. And this really is where you have to demonstrate that the company used those assets primarily for the qualified trade or business. And so that gets a little tricky. Things like research and development, or were they sitting with too much cash for too long? Those types of questions come into play. And then there's the last element is a disqualifying action, that there are certain actions that could disqualify a company from being eligible for QSBS. And the main one being stock redemptions, where the company buys back shares of its own stock. And so there are different ways to look at this, but basically there's a materiality threshold. And if the company repurchased more than that materiality threshold, they could jeopardize the eligibility of other stock that was issued within a year before or after the repurchase.
And would that, I mean, sometimes you see a founder really does something horrible and ends up basically gifting their stock back to the company to avoid the consequences of maybe what they did. And so all of a sudden we own 10% of the business and they're gone. We own 13% of the business or something. I wonder, is that the company buying the stock back? I don't think so. I think the stock just disappears. So the denominator gets smaller. That probably is not a disqualifying. It sounds like you're talking about a stock buyback.
Yeah, there are different types of, so you have to look at the nature of the stock repurchase. And so there are certain repurchases that are allowed, and that could be termination of an employee, death, divorce. There are different situations like that where things happen in life, and the company is not doing it to refinance the business. Basically, a way to think about the stock repurchases is the government, the IRS in this case, is very focused on how companies are using their assets. They want you to be using your assets towards the qualified trade or business. So if a company is using their assets to, like, namely cash, to buy back shares, to to help themselves with the
Yeah, that
appreciation of their
doesn't
stock.
fit with the whole kind of Jobs Act mentality of stimulating the economy and giving an
Exactly.
exemption to investors to drive that. So okay, so then the big qualifying bits are, it's essentially almost 100% of the things we invest in. But you want to invest in companies, if you want to get this tax break, that have on their balance sheet under $50 million of assets plus the size of the round. So if it's deemed to be 45 million in assets on the balance sheet and you invest $5 million financing into it, you've just screwed yourself by pushing it into the 50 million zone. And so there is no more QSBS. And so when we're doing a Series C, into these companies, it's QSBS is long gone there.
Yeah, and it's an interesting point, and part of what we try to do is help companies proactively manage this. So, to view their business activities from a QSBS lens. So, like, just to give you an example, we had a situation with an advisor to a company who had stock options that he was granted from being an advisor early on. I forget the date, but he exercised his stock options, and then he realized, oh, the company did a financing round around that time. Turns out 4 months before he exercised his options, they did exactly what you're saying. they had about $20 million in gross assets, and they raised 30. And so then uh, that round wasn't able to qualify for QSBS and any stock that was issued after that round. Now with stock options, he had these years before, but it's not when you're granted the options, it's when you
when you
exercise them in
exercise.
the case of stock options. And so he
Right.
missed the exemption by 4 months in that case.
Right. So you might think your cashless warrants or options are good to exercise at the minute of the liquidity event. It might make sense to be like, how much do I have to fork over in cash? And does that mean that I would have to buy my stock options or exercise them and hold them for 5 years in a day?
Yes, yeah, that's
Okay.
your holding period, your 5-year holding period
Yeah.
starts when you exercise.
Right. So we should have said this at the beginning of the call. So what this is all about is invest in a company where their balance sheet assets plus the size of the financing is under 50 million, and you hold your. You could sell a little bit early, but you're going to pay capital gains on that. QSBS exemption comes in when it's you've held it for 5 years and a day, unless there's rolling it. So 5 years in a day, that's the typical thing. And made the investment, 5 years in a day goes by, I sell, I have this great gain. I pay zero capital gains on the first $10 million or 10x my cost basis. So if I invested 2 million and made 20 million, then whatever's bigger, 20 million bigger than 10, I pay zero capital gain on the 20 million. And
Yep.
that's pretty sweet if you're the investor.
Yeah, it's great, and it's made even sweeter by some of these tax planning strategies, which might be good to bring up now because
Yeah.
um, so where sometimes people, if you know you're gonna have a large gain, you could gift shares into trusts, say for a child or family member, and the trust also benefits from the $10 million or 10 times your basis exemption.
Right. So just to follow that. So if you've got a gain that's bigger than 10 or bigger than 10x your cost basis, you can gift the shares prior to the sale of the shares. So the
Yeah,
key
yeah,
is
exactly.
before you realize cash exit consideration, if you gift, if you can see I'm heading into a $100 million exit, I could potentially make 10 gifts to different, LLC estates, and they each benefit from QSBS treatment of up to 10 million potentially there.
Yeah, potentially. There are considerations. You have to be a little weary of doing this.
Yeah, I think so.
And that when it has to be done properly. But the the IRS is certainly very very weary of like folks doing this just to avoid taxes. So you could do a few of them. You can't necessarily do $1 billion worth of trusts.
Yeah, listen, I generally think people should pay tax, and especially the people that were the first investors in Uber should be paying tax and not paying zero tax. And the balancing act is like Alan Patricof talking about why would you terminate the single most effective stimulus to the economy that's creating all these jobs? So we'll get to that in a minute. So
Yeah, and Alan was one of the folks that helped create this back in '93. So it's he's got a lot of insights as to why this is an important piece of legislation, and what it was intended to do, and um and what's kind of at risk if things change.
Right. And so let's talk about the history and what the future is of QSBS. So 1993, you said, was that when this came into being? And Alan Patricof, Graycroft, Apex fame and lore was behind the drafting of the original legislation.
Yeah, one of the contributors, and yeah, exactly. In '93, it was written and then rolled out. Entrepreneur with a great idea who's never run a company, the American dream to help invest in people like that who have uh, are lucky enough to find an investor willing to take a chance on them, and have an idea that might turn into something. So that's what was behind it. And it started back in 93 as a 50%
Right.
tax exclusion, and it was later increased to 75% of an exclusion. And it gets a little complicated from a tax standpoint, but there are certain tax add backs that made it less meaningful when it was less than 100% of an exemption. And it was kicked up to 100% of an exemption during the Obama administration in 2010. And as part of the Jobs Act back then, and really started, and that was for investments made then. So it still had to be 5 years until people met the 5-year holding period. So it was really in late 2015 when folks started to recognize 100% QSBS gain exclusions.
Right.
And then, in the last 2 years now, we've had a ton of exit events. And, so it's really started to hit the scene over the last couple of years.
Sure. It's not this is not unique to the United States. Like the UK has EIS, Enterprise Investment Scheme, and SCIS, and France has always had that. We have LPs from all these countries that invest in our funds and gripe a little bit that, like, if I invest into this local fund, it may not perform as well as yours, but I avoid paying any capital gains on this capital up to a limit that I put into a qualifying fund that's going to invest in French domiciled startups or the same EIS. But those things get a little nasty. Like EIS, you're basically buying ordinary shares. You're not allowed to have preferred shares with a liquidation preference and kind of a bunch of rights and privileges that are probably good. But so with the infrastructure bill, or the, what is it, build back better legislation, there is some talk about how are we going to pay for this multi-trillion-dollar spending spree. And I think they've identified on an annual basis the amount of lost revenue not being paid to the IRS from people that legitimately documented in good order their QSBS investments is, what's the number that you've seen?
Well, $5.7 billion. And this
Over
is
10
actually
years.
over 10 years. Exactly. So this is from the Joint Committee on Taxation. So they released their study just a week ago, so the end of September 2021, with projections out over the next 10 years. So we're talking about $500 or $600 million per year in revenue, additional revenue that they project the government will receive as a result of enacting changes, the
Right.
proposed changes that they're proposing to QSBS.
I mean, I was just helping my 13-year-old son with some algebra, and they're like, if Susie spends this much on her monthly Spotify account and pays this much for each download, how many songs does she have to download for it to be beneficial to switch to the higher paying subscription with a lower per song download? And it's like, this is a no-brainer algebra equation to me, that what is better for the revenue coming into the coffers of the IRS, allowing for $570 million of tax exemption on QSBS, which we've now explained, and having no payroll tax on the jobs that would not be created if we reduce the volume of money going into investing in QSBS qualifying small businesses in this country.
Yeah, and that's really what our position is. It's okay yeah, you might make $5.7 billion, and
over 10
the
years.
amount of over 10 years compared to 3.5 trillion in cost for this legislation. And so there are a lot of zeros in there, and it comes to about 0.0016. So it's less than 1%, 16 hundredths of 1% of the total cost of this Build Back Better plan. And, which granted, like, the government needs to identify ways to generate revenue, tax revenue from all different sources. And they add up to the amount that they're trying to raise to fund this plan. But to your point, like, what's lost if they take this away? How many investors are going to shy away from investing in people who have a great idea, and the next big idea? And so it's the piece that seems to be missing is just that, like, does this really negatively impact innovation? And where might it impact innovation the most? Like, there are certain states in the country that have a lot of wealthy investors, and the entrepreneurship community is close by, and they have more access than other parts of the country where you don't have billionaires funding companies, and and it is more individuals who are taking a chance on people, or smaller angel investors and early stage VCs. So it's the ramifications could be really large, and I don't know that there's any great study on what could be lost. Most of the studies out there are, is it really 5.7 billion, or could it be
Look,
double
I
that,
think I think this is the U.S. government kicking itself in the nuts and dragging us down with them for bad algebra. I think that even I've explained QSBS to investors before they invest in my venture capital fund, that we get QSBS and that passes through to them as a U.S. taxpayer. Even
Yeah.
if you're a green card holder in India that's paying tax in the United States, QSBS as an LP in the fund is part of what's happening here. And they can feel a little better about putting money into a fund that gives us a little more dry powder to fund one more company that
Yeah.
could be the one that makes 10,000 jobs, that has payroll tax and a multiplier effect of people spending that money like it was a stimulus check, right? And I think the other one is, what is the total size of this infrastructure bill now?
3.5 trillion, also over 10
3.5 trillion.
years.
So 3.5 trillion to be spent over what period of time?
Over 10 years.
Over 10 years compared to 5.7 billion
Yeah.
over 10 years. Well, if they take it away, I'm cool with it. I like the idea of our LPs getting a break and being more excited about being part of everything that we're doing here. But when you see at the state level, they say, oh, you're never going to leave Silicon Valley or New Jersey. So tell us about the states that have decided to not go along with the federal government's initiative here.
Yeah, it's an interesting history with all the states, and you mentioned countries as well, and how other countries treat treat capital gains. So some
Or
countries
startup breaks.
have no.
Yeah, they deem to say this startup qualifies for the SEA, for the Enterprise Investment Scheme.
Yeah.
So if you invest into that, you don't pay any gain if you put that money in the same year into, it's like a red zone, opportunity zone kind of thing.
Sure.
So
Sure.
even if they lose 100% of their investment, they're like, well, I was paying 40% on that 100K anyway.
And yeah. So along those lines, every state in the US treats QSBS slightly differently. There are a few major buckets. Some states conform fully to the federal government, and accept, okay, you're exempt at the federal government level, you're also exempt at the state level, no capital gains taxes. Other states say no, they're not conforming at all. Some like New Jersey and Connecticut are two of them. There are a handful of states that don't accept QSBS. So
But
even though you're
doesn't New Jersey say that if the small business is in the state of New Jersey, you get the exemption? We're just not going to pay for you to fund guys out in California.
there are different states that do that. I believe the latest information we have on New Jersey is that they don't accept
Okay.
QSBS at all. There was a bill proposed. It proposed in 2018 that would have allowed QSBS, that was confirmed dead or failed as of January 8th, 2020. So there have been attempts to enable QSBS gains to be accepted in New Jersey and other states where it traditionally hasn't been allowed. But the latest we had on New Jersey was that it's no longer allowed. California, similarly, as of 2013, stopped allowing QSBS exemptions at the state level, and California has the nation's highest state capital gains tax of 13.3%. So even though you're exempt at the federal level, you're still, if you're a California resident, still subject to the state capital gains tax.
Yeah. And I think for listeners, it's important to remember this is not applying to Bessemer writing $100 million check at a $900 million pre-money valuation for the latest, just shoving money around. And a lot of these guys in Connecticut and New Jersey are just writing such big checks. They were never going anywhere near QSBS to begin with. This is more, I think, for real venture capital, for real early stage, stuff. And Alan Patrickroft going from Apex down to a 50 million Graycroft when he first did that, I thought was brilliant. I'm saying, I want to be early. I want to be involved in helping make decisions and move these companies. Do you know, Jonathan, are you familiar with safes? Like there's convertible notes and safes.
Sure.
You know what this is as an entrepreneur. If I invest from a fund or as an individual into QSBS Expert's next financing round, and it comes in on a safe note, like that Y Combinator invention, what is your understanding of the clock beginning to tick on this being 5 years in a day, or qualifying for a rollover to get to 5 years?
Yeah, there are various schools of thought on this, but I guess if you start with convertible notes, which preceded safes, convertible notes are thought to be more debt-like. It's a debt instrument. It bears interest and has a repayment obligation, under certain conditions. So because it's more debt-like, it's a bit clearer that that's not equity, and QSBS is intended for equity. So convertible notes don't apply. QSBS clock doesn't start until convertible notes convert.
Yeah.
For safes, it's a simple agreement for future equity.
Right.
And so it's always intended to be an equity investment. It's a bit murkier. The Y Combinator released the latest version of the safe is the post money safe, and it's not really a question of if it's pre money or post money, but it's the post money safe. They included certain provisions to make it more akin to equity. So, and the IRS has really some private letter rulings where they said that they don't really care about having an actual stock certificate. They care about the economic substance of the security. And so, if the economic substance is more equity like, then there that's really more reason to start the QSBS clock at issuance. So there are certain items within the post money safe, such as voting rights, dividend rights. If there's a liquidation of the company, that safe is treated as though it were preferred equity and would be receive proceeds first. So all those types of elements were added to it to make it more equity like and start the QSBS clock when it's issued.
So I think that, I mean, I personally think don't play games with the IRS and pay your taxes and avoid aggressive, murky being used in a sentence with your decision on what you're doing with your tax. And if you were to not pay capital gains tax on a big outcome and then have it and then be liable to pay it back later would be a horrible thing. I think that convertible notes are good in certain situations, especially when the total size of the financing is very small. And when you see the size of the financing, or a well-known law firm is ready to do a priced round financing at a fixed rate, and you don't see your funding going largely into that, I say do the funding round. And you've got QSBS, you're documented, you're ready to go forward in the journey. If it's a safe, I think like you haven't seen precedents in courts really, rule over the interpretation of a safe being a pure equity instrument, when I think to some extent it's a promissory note. But the fact that there's no maturity date, it doesn't ever have to be paid back. Let me ask you another question, which is triggered by this, is valuation. So, some people say, oh, invest in my uncapped safe note. So the more I help the company, the less of it I own. When it converts, thanks to me, we introduced Lady Gaga. She tweets 1 billion downloads. Now I convert at $1 billion pre-money valuation, where it should have been 10 or 5 or 8. You said valuation is not necessarily the determining factor. It's assets on the balance sheet, which would include cash on the balance sheet at the time of your, inclusive of your investment or the total round, right?
Yeah, exactly.
So valuation really doesn't mean it. Like, so pre-money valuation of 250 million, but we took a good damn look at the balance sheet, and that's a real 2021 valuation. Like,
exactly. Yeah, the valuation, doesn't come into play for QSBS purposes. For other purposes, certainly like safe conversion. It's an entrepreneur would love to have a no cap, no cap note, because the valuation cap that's in the note helps determine how much the safe will convert into. But for QSBS purposes, it's the assets on the balance sheet, not the potential value of those
okay.
assets.
And so, speaking from QSBS Expert, your company, what are best practices that we investors should follow, whether we're investing directly in the startup or investing in a fund, or we're the fund and want to make sure QSBX is maximized to our LPs to get the best damn investment and be good at what we do? What are best practices we should cover? And then I want to talk about what you guys do.
Yeah, I think the best practices really come down to one, as part of your due diligence, are you reviewing QSBS eligibility? Two, as part of your term sheets or your in investment documents, are you holding the companies accountable to monitor their QSBS status? And those would be the primary ways. The other thing funds do often is upon an exit, they will survey the company or request that the company validate that their shares were qualified for QSBS. But and that, maybe to segue to what we're doing is kind of flipping that to say, well, wait a minute, a company could jeopardize their eligibility after you make your investment until your exit. So why wait until the exit to validate the QSBS eligibility? Let's proactively address it. Let's start to monitor this from day one, from either when you made your investment or, for the company's sake, when they got set up and founded. And so we created a platform. Our platform allows companies to do just that, to look at these criteria for being a qualified small business and assess themselves against the criteria, and then to contemporaneously document, to have a paper trail as they grow, to be able to validate at these various points along their life cycle, if they continue to meet the criteria, so that one day when there is the exit, they're able to say to their investors, yep, our shares qualified, here's the documentation to support taking the tax exemption. And so it's really as simple as that. There are two key questions our platform really addresses from a company perspective. Is number one, does the company qualify? And number two, which shareholders are most likely to care about this? So, all what we were discussing about safes and common equity, and you might have restricted stock and preferred, they all have different timelines. They all need to be assessed for the redemption period, a year before and a year after their issuances. So yeah, our platform also allows you to look on a security by security level to validate that the security met the eligibility requirements.
Yeah, I could imagine Carta wanting to buy your company at some point and just plug this into their end-to-end thing, which raises the question on founders. So sometimes I tell founders in my books that if you're investing money in your own startup, you should maybe do it on a convertible note yourself, and be in the preferred liquidation stack. So if you ended up putting $1 million into your company and it gets sold for half of the funding, at least you go home and tell your spouse, hey, we got a $500K paycheck and that 13 years was a bad use of time, but at least here's $500K, let's move to Mexico. But it might make sense to document how you're funding your company as an entrepreneur to be able to get a 10x on your cost base, as opposed to maybe capping yourself out at 10. What's your advice to founders, to, as long as this is still in existence and the government doesn't get the algebra equation completely wrong and cancel it, what should they be doing?
Yeah, I mean, it's a great point. And I don't know how many founders end up, receiving equity for those early investments in their own idea, and other than the equity, their founder shares. But it brings up a great point that, I know with our own company, I've put money in, and
Yeah,
and that's effectively the earliest investment in the company.
right. So
And
you could just say, go through the motions of saying, I bought shares in the company that I founded in month 3, month 6, and month 12 at a penny a share, and our assets on the balance sheet are under 50 million. Let's start that clock ticking now. No ambiguity, no convertible note, safe nonsense. It is what it is.
yeah, Yeah, it's a great point. The one thing founders should be aware of as well, like most founders receive restricted stock, and with restricted stock, if you file an 83B election, i- your QSBS clock will start when you file the 83B. So that's one thing to keep in mind as a founder, in addition to ensuring that your company meets the QSBS criteria to begin with.
Well, Jonathan, I want people to get a hold of you, and it sounds like startups be wise to figure out what do they have to do to get a quick health examination for QSBS. What should they be saying to investors, and how to ensure that they remain in compliance and good conduct to, if the government doesn't vote it out foolishly, that these people benefit and the jobs they create will hopefully pay more tax, and we'll have more money to build infrastructure, net of this. But QSBSexpert.com, is that the website?
That's the website. And then right on the homepage, you'll see a link to our platform page, and companies could sign up for free. We have a freemium offering, and really just helps companies address, okay, are we likely to qualify? And let's go through the basics and see if we check all the right boxes. And that, to a large extent, is what companies need early on. They need to know, okay, does it look like we qualify? What actions would disqualify us? So there's an educational component to this, that we're
Yeah.
helping the founders understand, okay, here are the things to be aware of. So if you're going to take any of these actions, let us know, and you're at least made aware of the things that could jeopardize eligibility going forward. And then there are upgrade options where uh, a company might need, investors want a formal report, or or the company wants to do a deeper analysis and monitor their use their actual tax returns and monitor their compliance, and do ongoing rolling monitoring. So these are all various upgrades. Also, the security bias, security class analysis is part of upgrade options. QSBS is the hot topic right now, but it's not the only element we're looking at. Um, we've been discussing QSBS Expert, which is really the first product of our company, which the formal name is Cap Gains Inc. And part of the reason for that is because QSBS is not the only tax incentive out there, but companies could qualify for other tax incentives that they're not even aware of.
Mm.
So a perfect example is opportunity zones, which you
Yep.
brought up as well. And so
Which has a
part
lot
of
of compliance to it. You got to make sure you don't change over time with a whole lot of
yeah,
things. You could easily
yeah,
screw that up.
yeah, similar to QSBS, you could easily screw it up, but it lends itself to assess it. Okay, are we an opportunity zone business to begin with? And then how do we continue to remain one?
Like, where are the
Um,
employees, as an example?
exactly,
Yeah.
and so there are elements of it that we're incorporating into the platform. So a company could be aware, okay, yeah, we're QSBS qualified, looks like we're opportunity zone qualified, and other tax incentives like that.
And a question I wanted to ask you earlier was rolling over. So what do people need to know about? So I invest in the qualifying business. I hold it for 5 years in a day. That's perfect. But I'm pretty psyched if I can sell the business after 2 years, make a huge gain, and then roll it in to another one to reach a total of 10 years. It's like being on a green card H-1B and you manage to move somewhere and not lose your place in the queue on getting your green card.
Yeah, yeah, exactly. And so what there is, there's a provision connected to Section 1202, which is qualified small business stock. There's a sister provision, Section 1045, that allows you to, exactly what you said, take your capital gain and roll it into another qualified small business, and they call it tacking your holding period. So you held it for 2 years. Now you only have to hold the new investment for another 3 years, and then your gain at that point would all be subject to the qualified small business stock exemption.
And
Now
can you
the
tack more than once?
you can you can but the part of the trick to this is, well, you only have 60 days to roll it over,
Uh-huh.
and it might, sound like, oh, you're a venture capitalist, so to identify a company, perform diligence on it, have them accept your investment, all within 60 days could
Talk
be
them
could
out of a
be
cap
tough.
of a convertible note into a priced round. Right.
Yeah, yeah, exactly. And so part of what we're doing is creating a large database of qualified small businesses.
Oh, okay.
And we have folks coming to us with, hey, I have 2 weeks left to roll this
Yeah,
gain
we've
over.
done that with LPs. We've
Yeah,
done it with individual LPs and gotten them into something to help them tack.
yeah, yeah, exactly. And that's what we're trying to formalize as well, to create a process for folks like that who are looking, for those kind of opportunities. And it's great, for the uh, company as well, because they're out there trying to fundraise, and they're psyched to find investors looking to roll over gains like that.
Yeah, you guys might be interested at some point. Are you familiar with the investor visas? Like if you
No.
now, like because with your database, that if you can identify that if an investor from like Turkey or Peru who wants to get his money out invests into a company located in San Francisco, they have to invest like $1 million into a qualifying company. And now they have an investor visa, but they better hope they chose well, because if that company goes bankrupt, then they're out. Whereas they can get their clock ticking towards their green card and become a citizen, or just be allowed to have indefinite leave to remain, as the Brits would say. And then if it's in the middle of, I don't know, some part of North Dakota, 500K will do you. So they do 500K in that. But again, it better not go bust. It better meet all the criteria. There's probably a bunch of things that you guys could keep your eyes on that be really interesting, and have a database that becomes suitable for all kinds of folks.
Yeah, yeah, and that's one of the areas we see this going as well, that, like, how do you properly set yourself up to maximize for, to maximize for these potential tax savings or various implications, like what's the best way to maximize for it. And like those investor visas that you're talking about, they're similar benefits to entrepreneurs who might come from another country to the US setting up a business to help speed up the visa process. And so there are interesting tie-ins like that to drive innovation in America. And so it's all kind of one and the same. What's gonna spur innovation in this country, and helping, a lot of it's gotten super complicated, but our mission is basically to simplify that.
Yeah.
And because the more we simplify it, the more folks could take, benefit from it and utilize these programs that the government's put out there.
Well, listen, Jonathan, thank you so much for coming on. Great to go over this again with you. And maybe we'll do an update if there's a change to the legislation, or get an update on how your cap gains business in QSBS is evolving.
Great. Sounds good. Thanks a lot, Andrew.
Okay, man. Thanks so much. Take care. Bye for now.